All right, welcome everybody. Today is Wednesday, July 16th, 2025. This is You've Got Options for Income Navigator. And today we are going to talk about the wheel strategy. So, today's agenda and what we're going to cover today, we're going to talk about what the wheel strategy is. We'll walk through the strategy step by step. We'll try to understand why it works. We'll discuss common mistakes that traders make. We'll look at a real quick example of the wheel strategy. And I just want to remind everybody that, this strategy is not about the hype. It's more about generating income in a repeatable and predictable fashion. So let's start with what the wheel strategy is. The wheel is a systematic strategy designed to generate income from options while reducing the stress of timing the markets. It starts with selling a cash secured put. Hopefully, you know what that is. Selling a cash secured put means we're selling an out of the money put, having enough cash and reserves to be able to take assignment, right? If the price of the underlying asset should finish below the strike price of the put that we're selling. For example, if we have stock trading at 100, we go out and sell a 90 strike put that expires in 30 days. If the stock is at 85, that 90 put is in the money. We're going to get assigned, and we need to have $9,000. It's 90 times 100 shares. We need to have $9,000 in reserves to be able to take assignment on that short put. If we get assigned, we then go out and sell a covered call against the shares that we get assigned, right? Whether the option expires or we get assigned, in any case, we will always either collect premium, right? We're collecting a premium for that short naked put. And then if we get assigned, we collect the premium from selling a covered call against the shares, right? And then if the stock goes the other way and it goes higher and our covered call is in the money at expiration, the shares would get called away and we'll make profit from capital. This will be a capital gain. We'll realize a profit from having the shares get called away. That will complete the cycle, right? And we'll go back and we'll try to repeat this same exact cycle. We'll go out, sell an out of the money put, collect the premium. If the stock remains above the strike price of the put that we're selling, we'll just get to keep the premium that we're collecting from that naked put. And we repeat the same exact step. We'll go out, whether it's 30, 45, 60 days, whatever the time frame is, we'll sell another put, collect the premium with intention to get assigned. And then if and when we get assigned, we'll sell a covered call, collect premium from the covered call. If the stock remains below the strike price of the covered call, we'll get to keep that premium. That premium will go towards reducing cost basis of our long stock position. And then we'll go and sell another covered call when the first or the second tranche will expire. We'll continue to repeat this until we get called away. Once we get called away, right, assuming we have collected enough premium to reduce our cost basis on the shares pretty good, we'll realize a capital gain on the shares, and that completes the cycle. And then we go back to selling puts again, right? This strategy, and this is very important, this strategy works best in a neutral to slightly bullish markets. It does work in a raging bull market, right? But you should expect to get called away if you are long shares and maybe you didn't sell enough covered calls to reduce your cost basis. As long as you're selling covered calls above your cost basis, you will eventually realize a capital gain on the shares, and then you go back to step one. But the best, absolute best market condition for this strategy is when the market is neutral, right? We go up a little, we go down a little, we go up, we go down, and we don't really trend in any direction, just kind of back and forth where we get assigned shares, we sell a covered call, and then the price will of the underlying asset will end up somewhere between your cost basis and that covered call. So we continue to hold shares, and the calls that we're selling expire worthless. We get to sell more calls, continuously reducing cost basis of the long stock position. So the core mindset, right? Most traders, they try to predict direction, right? And majority of traders out there, when it comes to options, right, they want to use the leverage that options provide. They need to predict direction, because if they're wrong on direction, you bought a call, stock went down, you lose money. You bought a put, stock went up, you lose money. So most traders will try to predict direction in order to benefit and in order to make money trading options. If we're going to rely on the wheel, we take predicting direction of the market out of the equation. We remove that completely. We don't need to predict which way the market is going to go. The only one thing that we need to really be concerned about is the underlying that we chose to trade really taking a hit and moving against us pretty good in the near term. And we need to kind of have a plan on what we're going to do if that is the case. With the wheel strategy, you're getting paid for calculated risk on pre-qualified stocks. And this is very important also because, stock selection is very important here. You definitely don't want to wheel stocks that you wouldn't want to own for at least 6 to 12 months if you were to be assigned. You don't want to, do the wheel trade on the stock that is the next hot thing and everybody's talking about it. Then 2 weeks later, no one cares about it because obviously there may not be enough liquidity for you to do what you want to do. With the wheel, success comes from consistency and risk control, not from forecasting. Let's go back to step number one. We sell a cash secured put. We choose a stock that we'd like to own for 6 to 12 months. Now, to each his own. You can look at different criteria when you're selecting stocks you want to own. You can look at, maybe you want to only own stocks that are, in the top 10 S&P 500 index. Maybe you want to select stocks that pay a dividend, because if you get assigned shares, right, you need to have some sort of incentive other than selling covered calls against the shares to generate income. You can also boost your income by holding shares. For example, I am running a TLT trade where holding shares pays a dividend and selling covered calls increases my income in the trade. So you may want to scan and look for stocks that have at least, maybe 3.5 to 6% dividend yield. So you can choose from that list. Selling a put below market price with enough cash for assignment. Again, this is very important. If you have a $5,000 account and you're selling a 100 put, you don't have enough to take assignments. So that is the wrong approach. Now, I know that sometimes we get fooled into thinking that, hey, I'm going to sell a 30 delta put, right? 70% of the time, the underlying is going to expire above the strike price. So even if I have a $5,000 account and I would need $10,000 to take assignment with a 70% probability of success, it's very unlikely that I will ever have to face that scenario. So I'll go ahead and do that anyways. Wrong approach. You're setting yourself up for failure. You want to know that you have the cash to take assignment. If taking assignment is not an option for you, but you would still you still want to kind of get into the wheel trade, then you need to have a stop loss, right? Because getting assigned is not an option. So if you have, I keep going back to a $5,000 account, you're selling a 100 strike put, which will require $10,000 to take assignment. Since you don't have the funds to do it, selling a put for maybe $2 if the underlying is moving against you, and now you're down maybe $400, maybe $500. You have to figure out when are you going to stop yourself out of that position, because you can't hold it until expiration and put yourself in the position where now your put is in the money, you have to get assigned, and you don't have the cash to do it, right? And sometimes your broker can go ahead and to protect themselves, they can force liquidate position because you don't have the capital to do it. So you don't want to put yourself in that position. So you got to think about, do I have the cash for assignment? If not, where's my stop loss? What am I going to do if, stock goes down, or have some sort of a, risk plan, have a contingency in place before you put the trade on. Now, if the put expires, you get to keep the premium. That's your income number one. If you get assigned, you move on to step number two. Step number two, selling a covered call. So assuming you sold a put, collected a premium, you get assigned, right? Once you get assigned, you sell a covered call above your cost basis. It's very important to understand your cost basis. Here's an example. Let's say stock's trading at 100. You sold a 90 put for $5, right? If assigned, right, your cost basis get reduced. So if you sold a 90 put for $5, right, you get assigned at 90 minus the $5 that you collected for selling that put, your cost basis is 85. So now if the stock goes to 80, right, you need to look to sell a covered call at 85 or higher, because 85 is your cost basis. You don't want to sell, an 80 call where you own the shares at 85, because if that is the case, if you sold an 80 call against shares that your cost basis is 85, if the stock goes back up and you get called away at 80, you will automatically lock yourself in the $5 loss times 100 shares. That's a $500 loss, just because you sold a covered call below your cost basis without realizing that, in the best case scenario, you get called out of the trade, and you will still realize a loss on your shares because you didn't keep track of the cost basis, right? If you get called away and you sold a call higher than your cost basis, you will lock in a profit, and you go back to step number one, which starts with selling an out of the money put, assuming you're going to get assigned. Now, if you do not get called away on your shares, so now let's say we sold a put on the stock that's trading at 100, we sold a 90 put for 5, right? Now we own and we get assigned. We own 100 shares at a cost base of $85 a share. We went ahead and we sold, let's say we sold a 90 call, right? This is a covered call against the shares that we own at 85. Maybe we collect another $5. If the stock ends, below that short call strike, now our cost basis goes from 85 to 80 because we sold the calls for $5. So now we have 100 shares at a cost basis of $80 a share. We could go ahead and sell another round of covered calls, except, we can sell it at 80. That would put us at a break even if we get called away. We can sell it at 85, realizing about a $5 profit if we get called away, or higher, depending on what the market is doing and depending on how much premium you can collect given the strike that you're looking to sell. So why does this strategy work? The wheel benefits from time decay, which also is known as theta, which is always working in the favor of the seller, right? You own the shares. If you're getting the dividend payment, that's great, right? But if there is no dividend and you're selling covered calls, every day, every single day that passes by, you get the benefit of theta decay, right? So you always get benefit because you are an option seller. In a sideways or a slowly rising markets, options tend to expire worthless, right? If you own shares at, let's say, cost basis of 85 and you sold a $95 call against your shares, right? If we're somewhere between 85 and 95 at expiration, that's another covered call that expires worthless, right? And we get to sell another round of covered calls. So in the sideways to very slow grinding or trending market, you're going to get the benefit of continuing to hold the shares, right? You're not getting a ton of pressure because the underlying is not going hard against you. And at the same time, the market is not really rallying very hard. So you get the benefit from holding shares. Maybe you get the dividend and you get to sell covered calls, drastically reducing cost basis for the time being. This strategy is also rule based, right? So we know step one, step two, where are we? If we get called out, we go back and sell a put, get assigned. Once we're assigned, we go sell a covered call until we get called away again. So very simple, very basic rules to follow. Don't really need to, think too much about it. And because this is a rule-based strategy, this will most of the time should, at least it should, but it will keep your emotions in check. You know, by repeating this system month after month, you will create a business-like approach to options trading. You don't have to guess. I mean, you can apply some, discretion, whether you want to sell a covered call that's at the money, maybe you want to sell a covered call that's out of the money, and that's based on your near-term price outlook. But for the most part, you know that if you got assigned, the next step and the only step is to sell a covered call. You keep selling covered calls until you get called away, and then you go back to repeating this process again. Very simple. There's, not too many deviations from the plan. You should know where you are in the plan at all times. You should also be able to keep track of premiums you're collecting. You should know your cost basis at all times. This way, if something changes in the market, right, you could make a decision whether next round of covered calls is going to be at the money. Maybe you have already reduced your cost basis so much where you can sell covered calls, you know, that may be in the money just because you no longer want to hold the stock. Maybe, there's earnings coming up. You want to get out of the shares. So you can use that, but that you can only do if you know where you own the stock. Now let's talk about, when this trade does not work. There are times when problems will arise, right? And most of the time, this happens when we deviate from our trading system. For example, right, these are some of the mistakes that we could make. Selling puts on super volatile or low quality stocks, it can lead to unwanted assignments, right? If you do not or you wouldn't want to own shares for at least 6 to 12 months, you shouldn't even think about running a wheel on that particular underlying. I don't care if Jim Cramer or whoever else may be talking about it like it's the next thing, since, it doesn't matter. If it's a low quality stock, if there's, very little liquidity in the options, you don't want to put yourself in the position where you could get in, but, getting out would be a problem. You also don't want to do the wheel on stocks that have, implied volatility of 250%, because, you could get, you can think that, selling a put on an underlying that has super high implied volatility will give you a lot of premium, and it will. But sometimes high implied volatility is justified. And when the underlying goes, 7 standard deviations to the downside, and your very far out of the money puts are going to become, very deep in the money puts. And then you're sitting there thinking, well, what's happening? This underlying is now, 20% below 200-day moving average. I didn't want to, do this, you know, and that's just the beginning to all the problems that you could potentially start to face with this kind of stock picking. So you only want to focus on solid names, stocks that you would own for the long run. Maybe you have already shares in your retirement accounts, and maybe you wouldn't mind using the short out of the money naked puts. Maybe you want to improve your cost basis, right? And maybe you want to build some kind of a core position longer term, or maybe you want to trade around your core position by buying more shares via selling short naked puts, and then getting out of that position by selling covered calls. You know, this is a great strategy to use in the retirement account, given that you have the capital to take assignment because you don't have any tax consequences to deal with, right? If you get assigned on the shares and then you get called away and you do that like 6 times in a year, it doesn't really matter because these are deferred accounts and you don't have to deal with tax consequences when you start to draw from these retirement funds. Another mistake you could possibly make is trading around earnings, right? Or something that may be coming up that could potentially drive the market in a big way. I think earnings is a big one, right? Um, let's look at, for example, Tesla, right? Tesla before earnings, you get super high IV, premiums are juiced. You may think, all right, this is it. I can sell a 30 delta put, collect so much premium, but we all know that Tesla could make a stupid move after earnings for whatever reason, right? Maybe earnings are bad. Maybe they didn't say something on the conference call. Next thing this stock, I've looked at Tesla and Tesla can move and moving, 30-40% for Tesla is not an outlier move. I mean, it doesn't happen too often, but it does happen a couple of times a year. So sometimes you may think that, your puts are very far out of the money ahead of earnings. Earnings is a binary event. You just want to commit and understand that what happens if the stock goes down 40% after earnings? What am I going to do? If you're okay owning the shares, then you know what? Maybe the premium is worth it. If it isn't, then stay away. So do always check for earning announcements in the expiration cycles that you're looking to sell your naked puts in. Another one is trading too large, exposing yourself to too much risk. Oversizing positions can, tie up a lot of capital, or worse, you may not have enough capital to take assignment, and all of a sudden your wheel trade goes out the window because you didn't follow the rule. Which rule number one: make sure you have enough capital to take assignment, right? If you don't have the capital to take assignment, you have to have a stop. Because sometimes, you may look at a put and you say, well, this put is trading for $1, whatever that put is, right? Maybe it's a 30 delta, maybe it's a 25 or 15 delta, it doesn't matter, right? You sell a put for $1 and you say, well, I'm going to only make $100 here. I don't want to make $100 here. I want to make, $5,000. And next thing you know, you're trading, right? 50x the size, even if your broker may only take very little margin up front. But if you fail to think about, right, the assignment and how much capital you need, right, the stock doesn't have to go too much against you if you increase size to, increase the premiums you're collecting in dollar terms. You can put yourself in the spot where, you can blow up your account. In the worst case scenario, you can also lose a substantial amount of capital because you are oversizing and you're focused on bringing in that premium with an account that is not qualified to hold that kind of risk. And worse, yeah, you could also end up putting yourself in a position from which you cannot make any adjustments. And if you do escape a complete wipeout, you will have, if you lose half of your capital, it's going to be kind of difficult to come back from that without, going forward and taking a substantial amounts of risk. And you definitely don't want to do that in your retirement account. Rolling trades out of panic without a plan, right? This tends to compound risk. And instead of reducing risk, if you continue to add on risk, this could potentially lead to an absolute disaster. So rolling, and we'll talk about rolling and reasons to roll. And rolling is, again, it's nothing more than closing a bad trade and opening a new trade. If you look at your trade that you're considering rolling to and say, if I didn't already have a position, would I be okay establishing that new position? If the answer is no, then rolling is really not a good idea. And sometimes, when the underlying starts to move against you, right, your first thing to do is to kind of, panic a little bit and you start to look for ways to roll. And there are ways that you can fix your position. You can also make some adjustments. And we'll talk about that. We'll do another session later this week. Probably do it on Friday, and we'll look at ways that we can fix wheel trades that do go bad. Some of the common mistakes, right? Chasing premium, no assignment plan, selling calls that are too close to basis, or worse, selling calls that are below cost basis. Because if we don't track our cost basis, that's a major mistake. And we think, oh, we're selling premium, we're going to get all that juice, and when it's all said and done, you get called away. And if you put it on the spreadsheet, you realize that, oh, you took a loss. Why? Because, well, you didn't get enough premium with those calls that you sold below cost basis. The underlying rallied, you got called away thinking you made a profit, but in the end, you actually realized a loss. And also, ignoring allocation rules is a major mistake that could potentially be very costly. These are my personal. There may be more. I mean, and I don't want anyone to take these as this is the only thing that works and everything else doesn't. But some of the basic rules that I like to follow, right? And I mentioned this before. You only want to use stocks that you would hold in a downturn. For example, if you believe in the company, 2, 3, 5 years out. And yes, there may be a chance that, you start the wheel, you get put stock, you own it for just a month or two, and then the market goes through a downturn, and you end up with not having enough premium to sell in a covered call to reduce your cost basis without going um, you know too far below your cost basis. So maybe you need to hold off on selling covered calls, you just own the shares, and you wait for the market to rebound, right? But again, if that is going to happen, at the very least, you want to hold stocks that you don't mind holding, right? If it's a stock that was the hottest thing 6 months ago and now nobody cares about it, and you end up holding that stock, and you start to realize that you know what, maybe I don't want it now, I'm not sure what to do with it. You should have thought about this before you started to make the trade. I would only focus on super high quality names, and again, not to single out any individual stock, but the Apples, the Amazons, Google, or maybe Meta, maybe it's Tesla, Nvidia, whatever you think is going to survive a downturn in the market, because we have to assume that over long periods of time the market is going to recover. Uh, you definitely don't want to sell calls below your cost basis unless you said, you know what, I'm already in the stock for 6 months, market's getting weaker, I know where my cost bases are, and now the market is really starting to accelerate to the downside. I just want to get out, right? Then you can sell a covered call below your cost basis to force yourself out of the position. Or I think another way to do it is to just flat out liquidate the position, get out, and don't 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 fall for the premium that you may be collecting from a covered call, because most of the risk you will be exposed to is in the long share position, right? So if you think the market went from being soft to now accelerating to the downside, maybe you'll sell an in the money call saying, you know what, get me out. If I sell an in the money call, this will reduce my cost basis down to where I'm at a break even on the entire position, or maybe at a slight profit. If things are getting worse, think about is it better to just liquidate the long share position, get out, and wait for the market to kind of balance before restarting the process of selling naked puts, looking for assignments again. This is an important one here. Keeping each trade below a 10% of your account, right? So if you get assigned, in our previous example, you have a stock at 100, you sell a 90 put. 90 put will require $9,000 of capital. That $9,000 should not be more than 10% of your account. So you need to have at least a $100,000 account in order for this to be a decent trade idea, right? So each trade should not tie up because not every single wheel is going to go bad. There is a chance that, every here now and then you will, find one of those stocks that, may go down more than you thought it could. And if that happens, if you lose, I don't know, 30% of what is tied up in that long share position, but that position is less than 10% of your account, overall you're not going to take a major hit, so you can continue to follow your plan, and recovery is going to be fairly easy. And that's because you're keeping each of the wheel trades down to below 10% of your overall account. And another one is don't rush, right? This is a monthly strategy, but that's not the only way to do it. You don't have to sell monthly. You can sell weekly. If you're doing SPY, right? SPY has expirations, almost daily, I think. And you don't have to do monthly. You don't have to do quarterly. There is no one right and everything else is wrong. You just got to do what's right for you. If you want to, for example, if you could sell a monthly covered call and collect $3, and instead you said, you know what, I'm going to use weeklies. There are 4 cycles in that month, and I'm going to sell weeklies for $1. Then you can collect $4 in total selling weeklies instead of selling a monthly for $3. But again, selling weeklies, you're going to be trading a lot closer to at the money, so it's a lot more aggressive approach. If it works for you, great. If you want to be a little bit less involved and you just kind of want to check in on your trades, once a day, maybe a couple of times a week, and go back about your business and do whatever you enjoy doing, then selling monthly, selling quarterly expirations are great. So there's not one strategy that works and everything else doesn't. You have to understand what works for you and only do that. So this is an example just to put some numbers around it. I kind of already gave a couple of examples, but let's say you have a stock, XYZ is the ticker symbol. It's trading at $105 a share. Step number one, you sell a $100 put. Now we can talk about, how to select puts to sell, how to select calls to sell. But in this example, let's just keep it simple. You sell an out of the money put. Why is it out of the money? Because it is below. Stock is at 105, put is at 100, right? So this put is $5 out of the money, and this put is selling for $2 per contract, or $200 in total. So if you are assigned at 100, right, this is the strike price that you're selling, your cost basis is 98. Why 98? Because you collected $2, which reduced your cost basis by the amount of premium you had collected. So you have to put up $9,800, or you have to put up $10,000, but your requirement will be reduced by the $200 of premium that you're collecting for that put. So your cost basis is now 98. You'll turn around and you look to sell, right? Step number two, we'll look to sell a covered call. We'll sell a covered call at 105, right? 105. Why 105? Because it's out of the money, right? We got assigned shares at 100. We have to assume that the stock is below 100. 105 call is out of the money, at least $5 or more, and it's going for about $1.50. If we get called away at 105, right, we'll make a $700 profit. And that's how small wins will compound. $700 may not sound like a lot, but if you do that 10 times in a year, if you can do that 10 times in a year, let's assume you can do that 10 times in a year, right? You'll collect $7,000 in profit if you do that 10 times in a year. How much money was at risk or involved in this trade? Well, we had to put up $9,800, right? Assuming the numbers will remain the same, but think about this. If you do this exact same thing 10 times in a year, and you'll end up with a $700 gain, that's a $7,000 profit on about $9,800 worth of capital, right? So $700 may not sound like a lot, but if you continue to do it once, twice, 3 times, eventually you're just recycling the same amount the same capital that you initially put up to get assigned on the shares, and you let these small wins compound and really show you what wheel and how powerful this trade is. All right, let's talk about managing risk in this trade. You always have to plan your exits in advance. You have to plan, plan, and plan. You don't want to start to look for a plan when something is already happening. Like you need to know, right? I already said that if you are, you know, going to do a wheel on a company that you may not really want to own, but right now market conditions are kind of in your favor, so you're going to do it anyways. Okay, that's, it's not illegal. Maybe you shouldn't do it, but it's not illegal, right? I have a trade in HIMS, right? HIMS. I don't really want to own the shares. If I was to get assigned shares, would I be super excited about it? Whatever. But I do know that if I do get put shares, and if, let's say the stock is trading at 60 or 50 or whatever, I sold a 40 put. If the stock goes down, I get assigned at 40 minus premium I collect. If it goes below 30, I don't want nothing to do with it. So I know about how much money I could potentially lose, and I have to be okay with this. That is the plan. If you're planning and you're not okay with losing that much money, this is not your trade. Don't do it. Right? But anything and everything you do, you have to think about the ifs and thens before you do the trade. You have to roll smart. You have to understand why you're rolling, where you're rolling to, what's the upside, what's the downside. Are you adding risk? Are you removing risk? We'll talk about that in our next session. You definitely want to avoid earnings. I said you can do this trade that we talked about just now, 10 times in a year. Maybe it's less than 10 times. Maybe you identify those cycles that have earnings. For example, if you're trading individual names, right? If you're trading SPY or if you're trading QQQ or some other index, then there is no earnings, so you don't have to worry about it. Maybe your biggest concern is the Fed meeting, or maybe your biggest concern is the next CPI release, or whatever. But if you are trading individual names, do look at the calendar and be aware that when earnings are coming, maybe I'm going to skip this one because I don't want to be exposed to a potential, 30% drawdown in the price of the underlying asset. And, so instead of 12 cycles, you only do 8, right? Because you have 4 earning cycles in a year. You also don't want to double down on losers unless we go back to the top of this slide here, right? You never want to double down on losers unless you go back to plan. If you plan on, instead of going all in, all out, if you plan on scaling in, scaling out, right? Maybe you want to utilize the wheel to build some kind of a core position and just trade around it, which means that you plan on using like a layered or laddered approach, right? Maybe you could potentially, let's say you have the capital to hold 500 shares of Apple, and you don't have to sell 5 puts outright. You'll sell 1 put, pretty aggressive, maybe a 35, 40 delta, with an assumption you get assigned. If you get assigned and the stock continues lower, well, you only got put 100 shares, but you plan on, right, getting into this position to the tune of 500 shares. So you get the first 100 shares of Apple, you sell a covered call, and you sell another naked put to potentially get assigned on another 100 shares of Apple, right? So now essentially you're moving from the wheel, you're getting into a covered strangle. And this is something that I'm currently doing with TLT, which slowly, stock hasn't done anything. It's actually just gone down. And because you're selling puts and you're selling calls, you're aggressively reducing your cost basis. And even if the stock had gone down, I think it's down from 93 when I started to wherever it is trading right now, and my cost bases are like somewhere in the low 80s. But again, everything has to be planned. If you plan on doing 500 shares of the underlying and you want to start at, 100 shares or 200 shares, you may break it down into three tranches: 200, 200, 100. Maybe do 100, 100, 300, whatever it is. You just have to plan not just your exits. You also want to, I should have added that you want to plan your entry and exits in advance so that all you're doing when the time comes is just executing your plan, right? So rolling, you also want to know, and you need to plan your rolls. You have to think about, okay, if I get put 100 shares and the stock is really moving against me, I'm going to do what? If you're going to, or if you maybe when we're talking about rolling, we're maybe talking about covered calls, right? So if you get the shares of, let's say, Apple at whatever price is, and you like the price where you own it, or maybe you were able to sell a couple of tranches of the covered calls where you reduced your cost basis to the point where you say, you know what, I really want to hold this stock for forever, or whatever the case may be. And now you're selling covered calls, and that covered call goes in the money. You don't want to get the stock called away. Now you're starting to think about rolling, and you want to roll smart, and you have to understand what it will do. So you definitely want to understand how and when you're going to roll. Are you going to let the covered call go so deep in the money that you're really not gaining any more reward for holding the risk? Maybe it's time to roll and capture some additional extrinsic value, but you got to think about all of that before you put the trade in or before you initiate the trade, right? So this is kind of very on a very basic level. This is risk management when it comes to the wheel trade. So just to recap, the wheel is not about it's not a shortcut. It's more of a tool, right? You can utilize the wheel to acquire shares for the long run. You also use the wheel to, instead of just sitting around and waiting for the stock to go down to the level where you want to get involved. I think wheeling is a great strategy. For example, if you have, let's say, Tesla, and you think Tesla is going to be, the first $100 trillion company, or whatever the case may be, right? You like the company for the long run. And in the meantime, right now, it's a little shaky. You're not sure. JP Morgan thinks it's going to zero, and there's some political pressures here and there. And you said, you know what? I would love to own the stock under 200-day moving average, wherever it is. I'm not going to go into charts right now, but the general concept is, okay, identify a level where you would like to own the shares. Make sure you have the capital to take the shares. Sell a put. If, and that's a big if it gets there, well, you wanted to own shares at that price anyways, so you'll get an assignment, right? If not, you're sitting around waiting for the stock to go around those levels where you wish you could buy the shares. Until that moment, you're just collecting a premium, right, from selling that naked put. So you're not just sitting there and nothing else is happening. You're kind of utilizing your capital. Maybe you have your capital tied up in treasury bonds, right? And in the meantime, you're selling naked puts in Tesla, wishing you could own shares at a much lower price. So you get the income from the treasuries, you get the premium from selling the puts. By the time you get assigned, you could potentially realize a decent return on that capital that would be sitting there idling, waiting for Tesla to go down low enough where you get involved, right? So that kind of makes sense. And I think that's a great way to accumulate and build positions long term. So it's not a shortcut, it's definitely a tool. You have to know your trade. You have to size your trades properly. You want to stick to the process, especially if you simplify it. If you just, try to avoid all the noise. We get, especially nowadays, we get headlines after headlines. Algos are going to push the market up, they're going to push the market down. Everything that's going on a day to day or intraday basis should not affect your strategy or your plan that you're following. So keep it simple. Where your boundaries are in that plan. Are you selling whatever you're holding at a profit? Are you getting assigned more shares? you have to know when your covered call is expiring, what you're going to do, what's your next step. Are you going to sell another tranche? Or are you just going to hold the shares? Is the market getting weak? You just want to, instead of selling covered calls, you just want to dump the stock. But you have to know exactly where you are in your trade. You have to know your trade, and you have to just uh, stick to your process. So I'm going to write a post on this so that we can reference back to it, and there you'll be able to also join where I could send you time to time. I'll send updates, or if I'm going to add something that may change about any one of these slides, I will add to it, and you will get a notification about it. So with that said, we have, maybe a couple of minutes. If you guys want to ask some questions, let's talk about it. I did see that we had some things popped up in the chat, so I'll try to answer if those are questions. First up, Bill asked, what about ETFs like SPY? I think that is a great, great underlying to trade, right? You can also think about something like, for example, I do a campaign style trade on SPY, and recently I started to sell out of the money puts that are a little bit closer at the money, right? So right now, if I'm looking for about a $5 credit on a out of the money put on SPY, maybe you say, you know what, I'm going to do a short SPY put campaign, and I'm going to use the wheel as kind of like bail me out scenario, meaning instead of selling a put for $5, maybe you'll sell a put for 10, right? Which is going to be closer at the money. And now you're planning if, right? Selling that put for 10, maybe your exit is at 50% of max profit, and that's going to work out really, really well in a slow grinding or mean reverting market. But should the market start to pull back, and now you get assigned on those shares of SPY, instead of freaking out about it, right? You say, okay, I'll get assigned on SPY. I have the capital to do it. Maybe I will pause my short put SPY campaign for the time being while I'm dealing with this wheel. I need to get out of these shares, right? So you kind of went from one strategy, you tied it into another strategy, but you plan on all of these things, on doing all of these things beforehand. I think that is great. SPY, QQQ, anything that's super liquid, because you definitely want liquidity, right? You don't want bid ask to be, 6 miles wide. You want to be able to get in and out fairly easy. SPY has pretty decent IV. Sometimes, yes, SPY is going to have, implied volatility of 18 or 16 or even 12. And sometimes SPY is going to have implied volatility of 28, right? But it's a reasonable implied volatility, very liquid. You can also use whatever index ETF, or maybe not index, but sector ETFs are fine too. XLK, if you don't want to do the QQQ, right? The tech sector, you can do maybe XLF if you want to. If you're bullish near term, or you think financials are going to kind of grind higher, and you don't want to go into individual stocks like JP Morgan or Goldman Sachs, Bank of America, and whatnot, then you can look at XLF. So yeah, anything that is very liquid, good tight bid ask spreads. And more importantly, it has to be something that if you somehow, for whatever reason, get stuck with, you don't mind holding it for a little bit. Jeff asked, what duration would you use for both the short puts and covered calls? So to make it simple, or kind of put it as a guideline, right? You can do it, right? 7 days out. We know that at the money options decay fastest with like 7 days or less until expiration, right? If you're going to go out and sell a 15 delta put 7 days out, odds are you're not getting enough premium to justify that risk, right? And if you look at, covered return for that far out of the money put, it's going to be, in a low single digits if you annualize that rate of return on the risk that you're taking. So I don't think it's really worth it. And we know that, by the time 7 days until expiration rolls around, anything that's beyond like 30 delta or less, all of that is just mostly tail risk. There's not enough, risk premium left. So the shorter the duration, the closer at the money you go. The longer the duration, the farther out of the money you can go, right? So, but I think a really good starting point is 45 DTE, 56 DTE, or whatever, somewhere between 30 and 60, and you can aim at about 30 delta. Another way to do it, right? If we're just talking about duration, so it's between 30 and 60. If you want to be more laid back, if you don't want to check on it too much, and yet you still want to go, pretty far out, you can go to a 90 DTE. But again, you have to understand that 90 DTE is going to be much slower than 60 DTE. 60 is going to be much slower than 30 DTE. And as you go down in days until expiration, you have to push your strikes a little bit closer to at the money. As far as covered calls, very important. You have to know your cost basis. Don't sell calls below your cost basis. You know, I think that if you have a stock that you don't really give a what about, then maybe you're selling something, 45 delta, maybe 40 delta. If it's a stock that you think has a good chance to rally in the near term, then you want to go to maybe a 30 delta. And as far as days out, again, you want to stick with that, window between 30 and 60 days until expiration. And the same thing applies, that the shorter the duration, the closer at the money you have to go in order to get a decent premium that's worth selling, you know, assuming the risk of, either getting put shares or getting called out of your long stock position. Hopefully that answers, Jeff. Time Merchant saying rolling is a good strategy to lock in a profit, but not so good to prolong a losing trade. Yeah, and you have to, go back to understand, what's happening. Do I still want to own the shares? If the answer is no, right? Meaning, if you have a position and you're looking at rolling, which means closing one bad position and starting another position, assume that you don't have already this bad position. Just think about the new position that you would be reestablishing. Would you be taking that position right there and then? If the answer is no, the market is too crazy, I don't want anything to do with the market right now, then rolling is, yeah, like you said, prolonging a losing trade, and probably not a good idea. And you're not rolling because you believe that the trade is going to work out. You're rolling to kind of, protect your ego, or maybe give yourself a warm and fuzzy feeling that, it's going to be okay. I'm going to be able to, roll my way out of this mess. Dean is saying, is there a video on short SPY put campaign? There is one. You go to Discord and type in short SPY put campaign, and you will see there's a bunch of links, and you will see it. I've done it several times. I've updated it recently too. So if you can't find it, just ask on Discord, and myself or anyone that's around, they'll point you to it. Dean is saying, when you use the wheel strategy, do you stagger the trades for cash flow purposes? Yeah, I think it's great. I mean, if you have an account that could only hold 100 shares, you can't really, ladder anything. But if you have an account where, doing 500 shares of Tesla is below a 10% allocation to Tesla wheel strategy, you don't have to do, all the shares all at once. You can say, you know what, I'm going to spread this out. I'm going to sell a put 30 days. I'm going to sell a put, maybe 45 days at different strike price, right? So now you're diversifying over time and over price. And eventually, if Tesla starts to go down, you're going to start hearing the ding, 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 right? You're getting assigned on the shares. As you get assigned, you start to sell covered calls. And in the end, right, by the time you get full exposure to Tesla, you are going to be able to lower your cost basis because, you diversified over price and over time. And, maybe you are able to collect enough premium by selling covered calls where you will, even if the Tesla is going down, but going down, slowly, you're always going to be slightly ahead because, well, improving your cost basis by layering your naked puts, also layering your covered calls, you're always actively reducing your cost basis and kind of keeping up with Tesla sliding. But maybe Tesla is not the best example here because Tesla tends to do crazy things, and if it's going to go down 40%, it isn't going to be over 8 months. This thing's going to go down 40% in a month. So Tesla maybe not perfect example, but yes, using some kind of layers of the wheel will actually improve your cost basis a lot more than being all in, all out type of trader. All right. So hopefully this helped, guys. We're going to cut it here. Later in the week, we're going to come back. We're going to talk a little bit more about the wheel. It's going to be a little bit more advanced. Hopefully you enjoy this. If you have any questions, you can find me on the Discord. Until next time, take care, everybody. Have a good day. See you in the next one. Bye-bye.